Astec Life Science is a company operating in the agrochemical space. This is a very interesting presentation on the topic. And if you really want to understand how agrochemical companies work and how they are transitioning to other chemicals and other business strategies, then you should watch this video till the end. So Astec Life Sciences has two business segments. The first is their enterprise segment, which where they directly manufacture agrochemicals, which are herbicides and fungicides, and they manufacture active ingredients for those agrochemicals. Active ingredient is that chemical which has the therapeutic effect or which has the intended effect in the entire chemical. And then you mix that active ingredient with formulations to give it a form, to give it a structure, which you can then sell in the market. So they sell it in India and they also export to almost 24 countries. And then they have CDMO or CRAMS business, which is contract development and manufacturing or contract research and manufacturing. So they are into CDMO and CRAMS as well, which is the main shifting point for this company. And that is the main investment thesis behind this company. तो इस प्रेजेंटेशन में इस वीडियो में हम इस कंपनी का एंटरप्राइज सेगमेंट भी समझेंगे और इस कंपनी का जो CDMO सेगमेंट है वो भी समझेंगे. So make sure you listen very carefully, right? First, an overall snapshot. So the company, their last 12 months revenue is 587 crores. Market cap is 2,700 crores. Price to sales is 4.7. Price to earnings is 459. Now, this might seem like an extremely inflated number, extremely overvalued number. लेकिन इसकी वजह क्या है? ये I'll come to that because the company right now is going through a downturn and the earnings have deteriorated a lot. So इसीलिए इसकी earning PE ratio इतना ज़्यादा है अभी. Share price is around 1400. So this is the segment breakdown and export versus domestic. So almost 3/4 of the revenue is coming from enterprise and 1/4 is coming from contract manufacturing or CDMOs, which is the higher margin business, right? And 61% is of the revenue is coming through exports, exporting to other countries, and around 40%, 39% is coming from domestic. Now let's have a look at the history of this company to really understand कि ये कंपनी कब शुरू हुई, कैसे शुरू हुई और आज ये कंपनी किस पोजीशन पे है. It was established in 1994 by Ashok from the Heikel Group, right? And it manufactured agrochemical active ingredients, which it still does. ठीक है? Then the company forayed into CDMO business, which is Contract Development and Manufacturing Organization business in 2011. We will talk about what CDMO is in the coming slides, right? In 2015, Godrej Agrovet acquired controlling stake in the company. 52% stake Godrej ने खरीद लिया, right? Then in 2021, Godrej bought the balance stake, which is the remaining stake from Ashok, to scale up their equity to 63%, right? And in March 2022, Ashok retired as CEO and Anurag Roy became the new CEO. So this is a brief timeline of the company. Earlier, Anurag was the COO, Chief Operating Officer of Manchester Organics, which is Naveen Fluorine's subsidiary. So this is the most important thing in this slide. कि नवीन फ्लोरीन जो है वो एक बहुत ही वेल एस्टैब्लिश्ड प्लेयर है CDMO और CRAMS स्पेस में और उसकी जो सब्सिडरी है मैनचेस्टर ऑर्गेनिक्स इज आल्सो वेरी एस्टैब्लिश्ड कंपनी इन द CDMO एंड CRAMS बिजनेस. उसका जो चीफ ऑपरेटिंग ऑफिसर था अब वो एस्टेक का CEO बना है. सो दिस गिव्स अस एन आइडिया कि ये कंपनी किस डायरेक्शन में बढ़ रही है, किस डायरेक्शन में बढ़ना चाहती है, राइट? Now what changed post acquisition by Godrej, right? So Godrej originally acquired Astec as a source to backward integrate their domestic business with manufacturing of active ingredients. So as you might know, Godrej is also a lot into agricultural products, and then they're also into dairy and other things. But the business of Astec seemed like it would provide synergy to Godrej Agrovet, and they even tried to merge Astec with their agrochemical business completely, but the minority shareholders didn't agree to the transaction. So after that, Godrej changed their focus to build CDMO business under Astec and launch new generation products in their legacy enterprise segment, right? So first they try to play with Astec as a purely agrochemical API play, right? And they try to integrate it with their existing agro businesses, but it just didn't work out. So after that, Godrej is trying to build Astec as a pure CDMO company, right? The journey started 3 years back with an enhanced focus on R&D and building capacities for CDMO, main business. Okay, now let's talk about uh, the main business of Astec, which is still agrochemicals, which is still fungicides, right? तो मैंने कहा कि Astec जो है वो CDMO की तरफ बढ़ रही है, but अभी हमें समझने की जरूरत है कि CDMO is still just 25% of the revenue, right? 3/4 of the revenue is still agrochemical or fungicides. पहले हम उस business को भी अच्छे तरह से समझते हैं. So Astec makes technical grade triazole fungicides. Now what does this mean? What does technical mean? Technical refers to the level of purity. Technical grades are still pre-production, so not the purest. If the product is meant only for agricultural use, then it's okay, but it can be refined further in the formulation stage. Okay, it can be refined further. So if a company is buying these chemicals from these active ingredients, these APIs from Astec, and they want to use it for some other role which requires higher purity, तो technical grade is not enough. तो उनको अपनी तरफ से formulation stage पे और refinement करना पड़ेगा. Fungicides, well, we all know what fungicide is. Fungicide is a chemical that kills fungi and is used to protect crops from fungal diseases. So, what are triazole fungicides? Triazole fungicides are fungicides that destroy fungi in two ways. They inhibit the production of ergosterol, which is a type of sterol that is essential for growth of fungi. So when they inhibit the production, the fungi dies off. The other thing they do is disrupting the cell wall of the fungus or interfering with its metabolism that also ends up killing the fungi. So this is what Astec makes, mainly triazole fungicides. And this is a triazole fungicide is a huge category, right? उसके अंदर और बहुत छोटी छोटी सब categories हैं, which we'll see. So the global market for triazole fungicides was $3.2 billion in 2018. So $3.2 billion is around 25,000 crore rupees. And out of which Indian market was $91 million, which is around 700 crore rupees. Right? Astec is primarily present in triazole fungicides, which we already saw, and they manufacture around 12 to 15 products, right? And you can see that they have like 20, 30 different kind of triazole fungicides in this category, and out of which they manufacture around 12 to 15. And even out of that 12 to 15, only two chemicals are the main, which give them majority of the revenue. We'll come to that. But one thing to note here, right, is that triazole fungicides have only been growing at 3.7% CAGR over the past 11 years. That is lower than the GDP growth of the country. That's lower than, like, that's very low. That's almost a dying market, right? So that is why we'll understand why Astec wants to move away from this business, right? So out of these so many chemicals, only two products, whose name is pretty hard to pronounce, tibuconazole and propiconazole, form nearly 80% of enterprise business segment. Astec has 3% global market share and 40% market share in India in these two chemicals. Astec has dependence on China for KSM. KSM is key starting material. So the very, very basic raw materials which is required for the chemical reaction, it is dependent on China for that. It was dependent on more advanced materials as well, but that has now come down after Godrej acquired it. Now let's coming to the problems of this business, right? The prices of these fungicides. So coming to the problems of these businesses, right? The prices of this. So coming to the problems faced by this enterprise segment of the business, the prices of fungicides can move up by 50% in any given year. And the fate of this molecule is obviously not in Astec's hands. So you can see these are different triazole fungicide molecules, and you can see how volatile the prices are, right? It's just going up and down, up and down. So it can move almost 50%. So triazole prices are very volatile, and because they're volatile, so you cannot really have a very stable margin. You cannot have very stable revenue when your very product is so volatile. right? So this is one of the problems. But the good thing to note here is that despite triazole prices rising at only 13.7%, Aztec's revenue grew at 14% annually. Why did this happen? So Aztec scaled their revenue six times in the last 10 years in a slowly dying market. How did that happen? The purity levels offered by Aztec and triazoles have not been matched by other players globally. So it is the quality of Aztec's product, right, that really enabled it to scale its revenue in an inorganic manner. So the industry was growing at 3-4%, but Aztec's revenue grew at 14%. This shows the quality of their product. This also shows uh, the quality of their management and how well they're able to grow in a market that itself is not growing very much, right? But finally, things are really slowing down in the triazole space, even for Aztec. So if you see the revenue for 2022, 2023, and TTM, which is the trailing 12 months, the revenue has constantly been going down for Aztec. So it was 677 crores. Then it came down to 628 crores, then 587 crores. So revenue has been declining very, very steadily over the last 3 years, right? So this is because of muted domestic growth. No one wants to buy triazole fungicides anymore, and there's pricing pressure in exports. Why is there pricing pressure in exports? Because what happened was in during the COVID time, right? A lot of the triazole fungicide factories in China had closed down, because of which the international competition uh, became easy to conquer for someone like Aztec, right? Because Chinese factories are closed down, so it was an opportunity for Aztec to ship more of their products, to export more of their products. But after the COVID has gone away, the Chinese factories are working and operational again. So that is why the competition has increased a lot in the global market, right? And that is why there's pricing pressure in exports, of which 50% is the USA. And then there is sharp decline in triazole prices, which we already saw previously, that it keeps going up and down. It's not very stable, right? So these are the problems with the triazole space. So does this mean that we don't need fungicides? But so no, it doesn't. It doesn't mean that, right? Because fungicides are essential for agriculture, and agriculture is essential for human survival, right? So if triazoles are not being used anymore, so what is being used? So another type of fungicide is taking over the market, and they are the SDHI fungicide. So they have a different mechanism of operation. They have a different mechanism in the way they, kill the fungi in the crops. So we're not going to go into the details of that. We're just seeing that there's another category of fungicide which is growing at 19% annually, 19% annual growth rate for the past 10 years. So the natural conclusion for us could be, and for other companies has been, that okay, so Aztec should just shift from creating triazole fungicides to now making SDHI fungicides, because it's a growing market and other companies have already done that. But no, this is not what uh, the management of Aztec is doing. Instead of venturing into SDHI intermediaries like SRF, which is also a very big player in the CDMO, which is also a very big chemical player in India, the management has decided to completely shift their focus towards CDMO segment. Why? Because they feel it's a much more lucrative business for them, and it will provide much more stable revenue and higher margins as well, right? What is CDMO? CDMO refers to contract development and manufacturing organization. So bigger companies, bigger innovator companies outsource their molecule development and manufacturing to low cost companies in countries with cheap labor like India, and cheap labor like China, and now India, right? Why CDMO? Well, because CDMO is a high margin and more secular. Secular means it's very consistent. So in investing terms, there are two kinds of businesses: cyclical and secular. Cyclical is when things go up and down, up and down, up and down in cycles. That is cyclical. Secular is when things are steadily rising all throughout, multi-decadal periods, like 10 years, 20 years, it's rising only. So that's secular. So CDMO is a much more secular slash sustainable source of business, as opposed to selling agrochemical intermediaries where demand is very volatile, right? So, what is the strategy then for Astec moving forward? Well, Astec will focus on smaller molecules in the CRAMS space, right? Mainly the proprietary off-patent products. What is CRAMS? Now, just before we move forward, just understand that CMO, CDMO, CRAMS, these are all basically the same thing. CRAMS is contract research and manufacturing services. CDMO is development and manufacturing services. CRO is research organization. So CRAMS, CDMO, CRO, these are all same things, right? So they're targeting small molecules which have potential size of 10 to 30 million dollars, and they want to be the sole supplier. So they are targeting molecules in the CDMO space which is not taken up by other CDMO players, right? That is what they're doing. Instead of competing with already established CDMO players like PI and Aarti and Naveen and Deccan, so वहां तो कंपटीशन बहुत हाई हो जाएगा, तो वहां सर्वाइवल फिर मुश्किल होगा। तो वो एक ऐसी जगह अपना नीश इस्टेब्लिश करना चाह रहे हैं जहां कंपटीशन कम है, right? So they are targeting small molecules which have a potential size of 10 to 30 million dollars, and they want to be the sole supplier instead of competing with other players. Astec did a capex of 150 crores for the new herbicide facility, which is being exclusively used for CRAMS business. This herbicide facility is now operational. The company will expand the addressable product basket by increasing the number of chemistries post commercialization of the new R&D facility. The margin is expected to be in the range of 25 to 30%, which is huge. Right now, the profit margin for Astec is only 9% for the trailing 12 months, right? So if CDMO becomes the majority of the business, so the margins can go from 9% to 25-30%. That's 3%, that's three times jump in the margin, right? So we can see a lot of operational leverage playing out over there.
Astec manufactures proprietary off-patent molecules for their CRAMS business. At present, management seems to have a visibility of 330 to 400 almost crores of CRAMS top line by FY25, which is a huge amount because their current revenue is around 600 crores, of which most of it is coming from their enterprise business and not from their CRAMS business. So if they can really scale up to 400 crores of CRAMS, that is huge. Uh, and this should be achieved by two molecules which they're talking about here. These two molecules for which they have already received order from Mitsui and LG Chemicals respectively. Both molecules have 10 to 15 million dollars gram size, but it could grow significantly up to 100 million dollars when innovators take registration in multiple geographies in comparison to dual geography registration. For the same, Astec has set up dedicated herbicide plant which has come on stream by the second quarter of FY 2022. Okay, so a lot of development in the CRAM space is already happening at full pace. Astec is perfectly positioned to pivot from pure technical grade triazole fungicide manufacturer to agrochemical CRAMS player. So from 13% of revenue to 30% of revenue, right? So that can really change their revenue growth trajectory, that can change their margins. So that's really the investment thesis over here. The growth in revenue along with higher buy coming from CRAMS should lead to a re-rating of Astec, right? Re-rating means it should trade at a valuation which is historically higher than the valuation of a company that does not do CRAMS, or valuation of a company that only is in fungicide manufacturing and not in CRAMS. So what is it doing, right? So it's investing in people. In terms of human capital, Astec has hired their COO from Deccan Chemicals, where he headed the R&D at Deccan, and then they have hired a CRAMS specialist uh, from Naveen Fluorine, right? Deccan Chemicals is which is the CEO now. Deccan Chemicals is larger than PI Industries in agrochemical CRAMS space, while Naveen is a large CRAMS player in the fluorine chain. So all these companies, right? Naveen Fluorine and Deccan and PI Industries, these are all very well established CDMO slash CRAMS players in India who have already given excellent returns to their shareholders because of the revenue and the earnings growth which they were able to show from their CRAMS business. And now Astec is also trying to go towards the same path. And for this, so Aztec needs to build relationship with innovators, which it has already started doing, right? They already have orders from LG Chemicals and Mitsui, and they need to do this more so. So just let's have a look at the supply side of innovators in global agrochemical space. And these are the big chemical companies, the big innovator companies, which gives orders to CDMO players. तो CDMO जो players होते हैं वो इन्हीं के client होते हैं. So they were like the top 10-15 companies में से भी जो top 6 companies थी, they have now consolidated to just become top 4 because mergers or acquisitions के through they have so the top players are really really concentrated, and these are the players which give orders to CDMO players, right? Building a relationship with any of them, the top 15 of them, is a function of time, like any relationship. The time spent doubles up as the entry barrier and goodwill from a vendor's perspective. And this is a 15-year process on average. So, Aztec for me personally is a very, very long term hold. Right now, it's going through a transformational phase, and I think it can do really well over the next maybe 10 years, right? So it's a very, very long term hold for me. With time, the innovator begins to outsource their requirements in the following buckets. So for products which are still under their pipeline, they would outsource R&D to the CDMO player. And then for products which are already patented, they will outsource the intermediaries and technical grade active ingredients for their patented products. And then products which are off patent, then they will right away give the out licensing and the manufacturing of the off patent proprietary product, right? Once established, once this relationship between CDMO and the innovator company is established, the vendor, which is the CDMO, grows with the innovator, right? Given the innovator's size, the rate of growth can be exponential for the vendor. How we'll see that? For example, PI Industries does 45 to 50% of their CDMO business with just one customer, which is Japan based Kumiai, and 25% with Bayer and Basef. So, Bayer and Basef are also two mega chemical companies on the global platform. What a long duration relationship ends up helping is vendors like CDMO players, that's what vendors are, become super specialists in a few molecules and their reaction process, uh, and it gives them a cost advantage. So vendors become super specialist in a few number of molecules, और उस molecule के पीछे जो reaction process होता है उसमें वो expert हो जाते हैं, and then they're able to scale it up, right? And it gives them a cost advantage. This acts as an advantage both for the innovator and the vendor, whether it's PI or Astec or any other company. And the scale of this relationship grows exponentially, क्योंकि अगर उनकी 300 मिलियन 400 मिलियन 500 मिलियन की ऑर्डर बुक है और अगर उन्होंने एस्टेक को सिर्फ 5 मिलियन का दिया, फिर एस्टेक ने अच्छा परफॉर्म किया, तो फिर वो 6 मिलियन का नहीं देंगे, वो सीधे 10 15 20 मिलियन का देंगे. सो फॉर एस्टेक, फॉर अ वेंडर, the growth curve can be really really L shaped, really huge. Understanding the CDMO implication for Aztec. So we are going to go over 3 points mainly. What is the India angle in the industry? Why are global innovators looking at India at all? Demand side, how is the demand side as of today? And what are the future growth plans? So how are they planning to venture into new chemistries? So these are the 3 things that we are going to understand for Aztec, right? So what is the India angle in this industry, right? Why are we bullish on the Indian CDMO space? Why are global innovators looking at India? So over the years, right now the top player, the country which is the top player in the CDMO space is obviously China, because it has cheap labor and pretty efficient country in a lot of ways. So China has significantly partnered with these innovators companies, while in India only a very few select firms have cultivated a specific relationship with innovators. But the thing is, China is getting unreliable by the day, right? China is getting unreliable by the day because of expensive labor, unpredictable policy changes, right? The government of China can just announce anything at any moment and things change. Although now we are getting a little bit of sense of that in India as well. Uh, but anyway, that's a separate topic. And given India's non alignment in global geopolitics, at least the Japanese, a lot of big chemical companies are Japanese, by the way, have a specific mandate to de risk these relationships in India and look at China. So, what other companies are looking at is if all of my manufacturing, yeah, if all of my R&D is placed in a country like China, which is very unpredictable, so what if my plants get shut down the next day? If the company thinks that way कि मेरा तो R&D डाइवर्सिफाइड नहीं है ग्लोबली, मेरा तो मैन्युफैक्चरिंग डाइवर्सिफाइड नहीं है ग्लोबली, तो अगर चाइना की गवर्नमेंट का एक दिन मूड ख़राब हुआ और उसने बंद कर दिया तो हमारा पूरा सप्लाई चेन जो है वो अटक जाएगी. सो दैट इज़ व्हाट इज़ मेंट बाय डी रिस्क, राइट? So they have a mandate to de-risk relationships in China, and therefore the next best option is India, because India also has cheap labor. प्लस इंडिया में और भी फ़ायदे हैं बिकॉज इंडिया हैज़ अ इंग्लिश स्पीकिंग पॉपुलेशन विच चाइना डज नॉट हैव, राइट? एंड इंडिया में it has the highest number of young scientists in the world. So those are the advantages that now companies are looking to shift from China to India. So with the smaller Indian companies who have already formed relationship with the Japanese innovators well, there is now a strong opportunity to take absolute wallet share as a part of this de-risking process. There is a very specific mandate amongst these companies to find a reliable second source of supplier, as we already talked about, right? In a nutshell, all smaller companies that have one or two key relationships and have executed well on them, they now stand a chance to face good incrementally strong growth rates, because CDMO is the next big trend in how chemical supply chain plays out.
So just a little bit more on contract manufacturing, right? So partnering with CMO, contract manufacturing organization, is a strategic choice by many pharmaceutical companies. The capital intensive nature of the business and complexity of the manufacturing requirements are among the primary reasons driving pharmaceutical companies to outsource commercial manufacturing. तो ये CMO होता क्यों है इसके बारे में मैं if you just check my previous videos, I've talked about this. Another factor include growth Another factors include growing demand for generic medicines and biologics for large molecules. While a small molecule manufacturing facility requires an investment of 30 to 100 million dollars, a large molecule can cost up to 200 to 500 million dollars. This the increasing share of small to mid the increasing share of small to mid biotech companies that lack infrastructure to create products. The increasing share of small to mid biotech companies that lack infrastructure to create products in-house also adds onto the CMO sector. The combination of these factors contributes to a CAGR of 6.4% in the CMO business, resulting in a global pharmaceutical CMO market valued at 162 billion by 2025 from 110 billion by 2019. So So there could very well be a $10 billion opportunity in the CDMO CRAMS business by 2025. So out of the total $230 billion CRAMS market, right, of which 74 billion is in research and 162 billion is in manufacturing, we can see $10 billion come to India. So assuming India can capture a conservative 4 to 5% of this opportunity by 2025, an estimated $10 billion CRAMS order book, with pharmaceuticals making up two-thirds of the potential market, while chemical making up the other one-third. PIE, Naveen Fluorine, and to a smaller degree SRF, Astec, and Aarti who already have a CRAMS footprint, are well positioned to leverage India's growing competitiveness and expertise in the global CRAMS market. So as the CRAMS industry is growing globally and there's a shift away from China towards India, and these players are already established somewhat in the CRAMS business. They have already proven track record, so they really are in a position where they can gain from this momentum towards CRAMS and CDMOs, right? So Astec today is where PI Industries was in 2010. So if we look at the domestic business, so right now in Astec, this is for PI, but for Astec, like 75% is coming from the enterprise business, and only 25% is coming from the CDMO business. And similarly, we can see in PI around 60% was the normal non-CDMO business, whereas around 38% was the CDMO business. But over the years, what happened is their legacy business, they shrunk the legacy business as a percentage of revenue, whereas the CDMO business, they kept on increasing and increasing and increasing until now it's three-fourth of the business is CDMO for PI, whereas only one-fourth is the legacy business. And so, how has this rewarded the shareholders? How has this rewarded the shareholders? So, we can see from the chart, the 10-year chart, that uh, the shareholders have been rewarded very well, right? This is the 10-year price chart for PI Industries, and you can see that the share has done phenomenally well. And another thing to note is that, for the past 8 years, which is majority of the time, the stock has also not been very volatile. It's a very consistent journey, right? So let's study more about this particular aspect. How did PI Industries, which has done so well, which reduced their legacy business and increased their CDMO business, right? How did PI Industries crack the code with CSM? CSM is just another term for CDMO CRAMS, contract services and manufacturing. Okay. So PI Industries had tie-ups with multiple innovators, right? Back in financial year 2010. One of the innovators named Kumai Chemicals from Japan had tied up with PI Industries to manufacture batch sizes of pyroxasulfone in 2010. Post several pilot stages and tests and approvals, Kumai Chemicals was impressed with the manufacturing quality and level of service offered by PI Industries. Post the same, they flooded PI with large scale orders of pyroxasulfone. So, this is what happens. These big innovators companies like Kumai or LG Chemicals or BASF or Bayers and all these companies, they will test out vendors like VI Industries, like Astec, like Naveen Fluorine. They will test them out with small batch orders. And once they see the performance, once they see the product quality, then they are going to give much larger, much bigger orders. So if you can prove yourself with the innovator, then then the growth can be really exponential for you. So once PI successfully executed orders for Komai Chemicals, the confidence of other innovators increased in PI Industries' ability to match manufacturing quality, beat cost, and most importantly, ability to keep the information about the molecule a secret and not compete with innovator in future for the same molecule. So NDAs, non-disclosure agreements, are very important in this industry. Okay, because these are intellectual properties, right? The molecules and all these products are intellectual molecules. These are patented. So if information is leaked to the competitors, so they can also start manufacturing similar products, and innovator can lose market share. So this is very important. And also the innovator would not like कि हम जिसको CDMO को offer दे रहे हैं वो हम ही से फिर compete करने लगे. So these things are also very important in this space. And Indian CDMO players have been very well able to respect these boundaries. They are very good in keeping the secrets. They will never compete with innovator molecules, especially PI Industries, right? So this is what these innovator companies like Kumai Chemicals in this manner they liked. And then not only will Kumai Chemicals give more orders, but other innovator companies will also give their orders to PI Industries or other similar companies like Astec if they know that their secrets will be saved. Their secrets will not be mixed up with other companies' information, right? So these things are very important. So given right, so given Astec's journey, the management has visibility to scale the existing CSM business from 85 crores to 350 crores by 2025 based on order visibility from innovators for products like tiafenacil and cyclopyrimurate. Now, the thing is, the entire revenue for Astec right now is around 580 crores. So this is 350 crores of revenue is huge. And this is just the order visibility right now. This can go up exponentially, right? Once Astec is able to execute small to medium scale orders for the molecules mentioned above, the innovator's confidence in Astec's ability should rise, leading to a journey akin to PI industries. In a nutshell, there are sufficient market opportunities, 6 to 7 billion dollars in agrochemical CSM CDMO for Astec to capture. Right, the $7 billion would be like absolutely huge. I think this is an overstatement, right here. Uh, but yeah, $7 billion is more than 50,000 crores, right? The success of the CSM segment depends on the kind of capabilities that Astec is going to develop and the level of service they offer to the innovator. If done well, sky is the limit. Astec, I think, could easily double the revenue, uh, you know, uh, 5 to 7 times in the next 5 years and almost 15 times in the next 10 years, from a current base of 85 crores in the CDMO segment. So I'm talking about the CDMO segment, not the entire revenue, right? So, what's the second point? That was the first point, कि India का angle क्या है? The second point is demand side. So as of today, the demand side for CDMO is very robust. Most of the Europe-based companies in contract manufacturing model are booked out for capacities for the next three to 4 years. So, the demand is very strong. Post the environment compliance issue with Heikel, which they had one, a few customers are looking for alternative supplies, which may help Aztec build a new relationship. So in a recent con call, Astec CEO's tone was that there is no demand constraint, and it's just that they have to deliver on R&D and capacity. They plan to reach 100% utilization for the new herbicide plant, which we recently talked about, uh, in this financial year only, which is FY24. Astec has a wide customer base, and top 10 customers contribute to 60% of revenue. Future growth plans. So this is directly from their phone call, and that's when we developed competencies within the R&D as well as commercialized the new herbicide plant last year. We'll continue to improve our skill sets in that area, expanding into areas like sulfonyl, urea, backward integration into pyrimidine, and then eventually into the fluorination chemistry. So that's the journey or the path which we plan to take on the medium term basis. And then subsequently, based on our CMO partnership or relationships with customers, we'll continue to look for opportunities to expand into adjacent technology platforms. So they are really going all in the CDMO CRAM space, and they will not limit themselves to any one particular kind of chemistry. They're really going all in to this space. So, but keep in mind that this is all forward-looking statement, right? And over the last few quarters, their revenue from the CDMO has tripled already, so they are performing well. But do note that this is a very, very long-term thesis, which might play out over the next 3 to 5 years, right? So I am bullish on Aztec, and just as a disclaimer, I do have a small position in my portfolio for Astec Life Sciences, and this is my investment thesis, right? I feel that uh, the enterprise business, which is not very profitable, will be phased out, and the CDMO business, which is much more profitable, will slowly form the majority, of the business in the coming years, which will give a much higher revenue growth, much better margins, much better profitability, and much more predictable business, which can lead to a re-rating of Aztec Life Sciences as a business, and that is the long-term thesis that I see for this business. So that is it. This was a difficult video. It took me more than a week of reading and preparing the presentation to put all this together. And you might want to watch this video maybe 2 or 3 or 4 times to fully understand what's going on over here. If you want any help with your portfolio, then you can get in touch with me on this number, and I'll be happy to help. And if you have any questions with regards to CDMOs or CRAMs, then you can just comment below and I'll be happy to answer. Thanks for watching.